Good morning to everyone. It's a great pleasure to see you virtually. This year, in this special year, we thought it was important to have the opportunity to present a pillar of the EMF publication, which is Hypostat, the edition 2020. We really believe that we are living in unprecedented times, and we need to have a strong quantitative basis to analyze how our life, how our markets are changing. Without numbers, we cannot have, I would say, a quantitative analysis of what is happening. And without a good and solid quantitative analysis, our views are just and simple opinions. We feel that we have the responsibility to give strong indications of where the market is going and what is the most appropriate way to frame the European markets to secure integration and capacity to the markets to be able to leverage the recovery and give opportunity to the real economy. That's why we are here this morning. And that's why I would like to start the day by saying a couple of thank you. Well, first of all, to Paul and Daniele, who put together a fantastic publication, which is a benchmark, is used by a broad audience, central banks, journalists, passionate of mortgage markets. We have also those kind of people in life. And it's really a basic for the analysis of the mortgage market in Europe. What is the value of this publication? The value of this publication is that we try to put together the official numbers coming from official data sources like Eurostat, central bank database, and the market perspective. We try to have ears and eyes in every single market in Europe, try to digest these numbers and trying to think together of what are the implications for the broader market. So I would like to extend our thank you to all the authors, but also to all the people that have decided to be with us this morning and to share their views, their opinion on where we are going. So this is the plot for today, trying to analyze the key thematic areas which are impacting the mortgage markets, to see how the markets are actually integrating and how we have to try to work together in a very heterogeneous market situation. This is what we are trying to do, and I'm very glad to have all these distinguished panelists to discuss about the direction that we have to take and where we come from. That's I will not say anything more than this. I would like to give the floor to Paul for introducing Hypostat, and then Daniele will give an overview of where we are in terms of numbers. Thank you all for being with us this morning. Paul, the floor is yours.
Yes, thank you, Luca. Hopefully everyone can hear me. Welcome to the World Wild, and I will want to say Hypostat 2020 virtual publication event. Hypostat, it's not our first publication, of course. We're back to 1998, and like Luca said, Hypostat is now considered as a valuable publication. Our data is used by our members, of course, and increasingly also by scientific research. You can read it also now in the 2020 publications. We have a few scientific articles in it. Please read it. Like Luca also said, Hypostat is a benchmark for analysis on the European housing and mortgage market. I'm a Dutchman, like you here now. And it is an intense cooperation between financial markets, analysts, the national banking associations, and the most eminent mortgage and housing market experts in Europe. Thank you for that all. Hypostat brings together historical, and Daniele will show that, historical annual series of 30 indicators, covering, when the data is available, of course, for over the European Union members and also 12 other countries beyond our borders, and for the first time also Iceland and Norway. And Hypostat is very important because we are let me say, democratic countries, and we are committed to ensuring fair and sustainable societies. And also housing and the way we operate it in the housing and mortgage markets are relevant for our future. You can read it also in Luca's foreword. And that's why we have points 3 and 4 on the agenda. It's about the COVID-19 pandemic, the impact of that, and the energy efficiency mortgage. I hope everyone will have new information in the next 2 hours and have new inspiration to continue with initiatives for a better energy efficiency future. So I give the floor to Daniele now.
Thank you, Paul, and welcome to everybody also from my side. Let's delve a bit into the statistics, but before going to the main findings of Hypostat 2020, a very quick disclaimer. As you know, Hypostat is an annual review, and its findings rest until end year 2019. Therefore, all the important, let's say, shifts and impacts we had from COVID-19 have been touched upon in writing in a more qualitative basis, whereas on hard data, the data rests on 2019 numbers. In any case, during this next 10 minutes, I will touch upon some figures I took from the quarterly review, which already now has been published a month ago and goes until Q2 2020. So, first of all, let's delve into the figures. Of course, housing market has rests on a bit also a macroeconomic overview. In 2019, the economy still went relatively well. We see here in this chart every country of EU27 and the United Kingdom showed positive GDP growth, and nearly everybody had unemployment decrease. Except for Sweden, Lithuania, and Luxembourg, who was mostly stable, but overall the picture was quite fine. Getting into the house prices. House prices in general showed an increase in 2019. However, they decelerated a little bit with respect to 2018. So in 2019 we had around 5.9%, whereas in 2018 it was 6.3%. As you see here in these graphs, where I have subdivided by regional areas the database, nearly everywhere in 24 countries out of 30 which are here plotted had some sort of trough between 2008 and 2019, which was mostly around 2013 as a year where the house price index was the lowest. However, as you see, the pictures were quite different. In continental Europe, on the top left, there was nearly everywhere quite a smooth growth, continuous growth from 2008 to 2019, except for Norway and Ireland, where they had a little bit more of trough. We had a contraction till 2013 and then increased. In south of Europe, the top center top chart, the situation was a little bit more, let's say, dispersed. Amongst other, I would like to highlight Italy with the yellow line, which was the only country in the whole data set where we had actually a peak in this period in 2010, and from there onwards an ongoing contraction, which finally ended in Q2 2020, where we had a first, let's say, house price increase. In Central and East Europe, the trough was mostly pushed towards 2014, 2015, whereas in North Europe, the trough where it was located more at the beginning of last decade, or at the end of 2 decades ago, 2009, 2010. You see that more or less everywhere from 2013 and especially from 2015, there was a sustained growth. In some cases was also very important. Just to highlight, Hungary had a very important, let's say, growth, and mostly due to a catch-up effect because they were quite severely hit in the previous during the previous crisis. So there was a catch-up, but there was also a growth higher than the pre-crisis level of 2007. In general, in Q2 2020, the house prices are now more or less flattened out, and more countries start to have a slight decrease. We don't want now to already say it's due to COVID, because it seemed like also it's more or less a natural cycle, because as you see, most had quite sustained growth over the past year. So we need to see over the next quarters how this evolves. Let's go a little bit more into detail regarding house prices between country and the cities. As you very well are aware, on the country, the capital cities or cities in general behave relatively differently from the overall country. Here in this chart, we wanted to show you how different. All countries you see here depicted in the top right quadrant show that the capital city increased by even more with respect to what the overall country was increased. As you see on the top right, the most stark example is again Hungary, where Hungary as overall country increased by between 2013 and 2019, so by the general trough till the last number available, by 120% the house price. And on top of this 120%, Budapest increased by other 65%. So Budapest in these last 7 years increased by nearly 200% of house price. But again, as I said, it's mostly due to a catch-up effect. In general, we can say that the capital cities increased by around 10-20% more than the overall country. But as you see also in the other quadrants, we have some, let's say, exceptions. For example, the country where we are located here in Belgium saw that the overall Belgium was increasing by 20%, whereas Brussels alone was increasing only by 10%. Then other countries, like for example Cyprus and Italy, the capital city was decreasing even more than the contraction of the overall country. And this may also provide us some interesting insights on the dynamics of these different cities. Moving towards house price affordability, of course, considering that it's strictly connected. With these increasing numbers, increasing house price numbers, affordability also suffered a little bit. In 17 countries of our sample saw in 2019 a deterioration, and 15 countries of these samples saw that in 2019 they were worse off with respect to the long-term average from 2000 till now. Especially hit, we see again, it's Hungary, Austria, and Portugal, but also the UK and Sweden, Norway had quite a deterioration over the last years. Related to COVID, it's also interesting to see the overcrowding in dwellings, which is an issue for 70% of the European population, and this is, let's say, especially dramatic for those households of poorer households, and especially in the eastern part of Eastern Europe. So it will be interesting also to see how this will impact in the next months the COVID crisis. Let's go quickly on the housing supply side. Here, on overall in Europe, in 2019 saw a small contraction of new building permits with respect to 2018, a 1% contraction, so nothing too large. However, as you see on the top chart, a relative majority of countries saw some contraction in 2019, whereas others still were healthy, expanding of over 10%. It's interesting to see that those who are expanding 10% had, and this is the blue part, in 2019 already quite a large house price, quite a large building permit with respect to the previous year. So we see that there are also different cycles at hand. Interesting also to see, and here it's the chart below, that on average building permits in Europe in 2019 would cover a little more than 0.7% of the overall building stock. It's more than 2013, where we only had 0.5% of the building stock of building permits covering the building stock, but it's still lower than the 1% which we had in 2007. So also here, linking a bit to the renovation wave we would discuss, that will be the bulk of our energy efficient mortgages, because new buildings are really few with respect to the overall building stock. Some considerations about the mortgage market. In Europe, we are now closing out to 6 trillion of outstanding, not considering the UK, who is the largest mortgage market. Here we look only at EU27. It's quite it's a 4% increase with respect to previous year, and also in gross lending we saw 13% increase to previous year, reaching nearly 1 trillion of new issuance. This makes around 44% of GDP. The mortgage market makes out of 44% of GDP. And it's quite an important number, showing also the structural importance of the mortgage market. Let's quickly go through to see who is where this mortgage market is mostly located. You see on the right-hand side a diagram where the quadrants show the different countries. We can say that the 6 largest countries make up over 80% of the mortgage market, and the striped section is the UK, which of course now with Brexit we tried to provide them still. We will provide them still in our statistics, but we need to provide a little bit of a graphical differentiation just to see the different point. It's still the largest mortgage market in Europe, and I dare say after US and Japan also of the world, with 1.6 trillion, followed by Germany, France, and the Netherlands. Also on gross lending, we can see that there is a big increase with respect to 2013. I made here a comparison between what happened in 2013 to what happened in 2019. Some countries like Portugal, Hungary increased their mortgages by a multiple fold of those years, but of course we have to consider that in those years they had a very subdued market, whereas in other countries we still saw in the last 6 years around on average a doubling of the mortgage market, of the mortgage gross issuance. Looking also into the new year in Q2 2020, we saw that gross lending was contracted substantially in Q2 2020 by 7% with respect both to the previous quarter and to the same quarter of the previous year. So there was some contraction, but also here this contraction is, let's say, concentrated in some countries, whereas in other countries the COVID crisis had less of an impact. Last but not least, on the interest rate side, interest rates continued to decrease in 2019 and also in 2020, following a long streak of decrease starting in 2011. However, we can say that from 2017 onwards, this decrease, as we are reaching floor bottom, was not that marked. And you see also here the dashed line, which is the variance, so a bit the dispersion of the various interest rates, started again to increase slightly. So we see that the various, let's say, interest rates are following a bit more different paths. And with this very, let's say, low interest rate and ongoing low interest rate, which continued also in Q1 and Q2 of this year, now in our sample of a quarterly review, we're talking about a 2.09 average percentage rate of new mortgages. This also reflects on the appetite for variable interest rate mortgages in Europe. That's the last chart here on the bottom, where we see that on average the share of variable interest rates is decreasing. Now we are for the first time below 20%, marking around 270 billion of new issuance having a variable interest rate, meaning interest rates, mortgages would have an interest rate of fixed period below or 1 year or up to 1 year. And having had a lot of new issuance, the absolute value increased a little bit. And we see here also from the breakdown, the highest appetite for this is in the Nordics, and we saw also here the larger increase here. But there has not been that much of a change since the last since 2015. And this was my quick overview of the statistics. Of course, all this information are available on in the Hypostat, and you're very welcome to either you can ask me again later some question, or you can also send me some emails. And with this, I would like to give the floor to our first panel on the impact of COVID-19 pandemic, moderated by Luiz de Mello and Danae Kyriakopoulou, with panelists Richard Kemmish and Gyula Nagy, who will present us a little bit what the impact of the COVID-19 pandemic on the housing and mortgage market have been. Luiz, Danae, the floor is yours. Thank you so much.
Thank you, Daniele. Very interesting presentation. Hello, everyone. Good morning from London. Very interesting statistics, but as we saw, these mostly don't cover the impact of COVID ending in 2019. What we've seen, and the article that Luiz and I wrote in the publication looks at the policy responses that governments, central banks, and other institutions took in response to COVID-19. Of course, housing has been one of the areas that have been very much affected, both in terms of the issues such as overcrowding and so on that Daniele just presented, but also in terms of the measures that we're seeing in the broader economy with regards to interest rates, macroprudential policies, and so on, and how they are affecting the housing market, but also in terms of the longer term changes that we are seeing in how people work and live at home, the kind of expectations that they may have from real estate, both commercial and residential. So I'm very pleased to discuss these issues with this panel. So let's start with you, Luiz, and at any point, if you have questions, please write them in the chat, and I'll do my best to kind of ask panelists about this. But let's start with you, Luiz, to give us an overview on what policies we've seen so far that different countries in the OECD and beyond have taken to support people in this crisis with regards to the housing markets.
Indeed, thanks, Dana. Hello, everyone. It's really a pleasure to be with you today, and of course, huge congrats to Luca, Jennifer, Paul, Daniele, but also Sophia, Richard, all those involved. That I'd say the sharp end of putting the reports together. It was really extremely interesting, and I think Dan and I are proud to be associated with you in that. As Daniele mentioned, we try to focus in that chapter on the measures taken by governments, especially focusing on the immediate responses to the crisis. But I would like also to take the opportunity, since there are some encouraging signs about vaccines and all that, that we can start looking at the recovery phase beyond the COVID. So three points come to mind with respect to that. And given the constraint of time that we have, I'll just try to be very brief on those 3 points. One is that the measures that have been taken to basically support people during the pandemic have longer-term consequences that will need to be addressed in the recovery period. What do I mean by that? Well, most countries, what they did was to focus on payment forbearance. For rents, for mortgages, for taxes, so that people could, deal with housing costs, given the difficulties they are facing related to income losses during the pandemic. But a lot of those measures, so basically changes in regulations of tenant owner relations, and even as Danae mentioned, the macroprudential regulations, a lot of those, if they are kept for too long, they may have an effect on investment in new construction, investment in renovation, investment in the upkeep of the housing stock. So those disincentives for investment, if you want, that may be associated with those measures will need to be taken into account moving forward. So very important to have lots of support during the rescue phase, but as we move to the recovery phase, we'll need to look at some of the unintended or adverse consequences of those measures. So that's one point. The second point is that the pandemic is likely to have or to basically to lead to changes in behavior that are likely to stay beyond this most acute part of the crisis that we are facing now. For instance, if teleworking becomes widespread or more prevalent than it has been, that will affect the demand for housing, that will change or reshape the demand for office space, and so on. So that will have certainly consequences for the way we look at demand patterns evolving, the way supply will react to that, not only for real estate, but also for transport infrastructure, urban amenities. So it's consequences that go beyond the real estate sector itself. Take, for instance, the case of e-commerce. There has been a huge expansion of that in the first few months of the pandemic. So if that stays on, if those trends persist, that will have a consequence for demand for commercial real estate and so on. So those underlying changes that are due to COVID, if they persist, they will affect demand patterns, they will affect supply, and we'll need to live with that over the next few years. And the third point I wanted to make, that is not related to COVID per se, so it's underlying trends that we were facing even before the pandemic that will change the way the markets work. Take, for instance, digitalization, the emergence of fintech, for instance, that will have implications for housing finance moving forward, the way the market structure, the number of participants, and so on. Another aspect of digitalization is how it's changing the technology of construction. So that will have impact on or repercussions for sustainability considerations, but also for productivity in the construction sector itself. Population aging is changing already the demand for housing, creating a lot of opportunities for retrofitting buildings, for changing the urban landscape. So those underlying trends will be with us. On top of those, we have those that are related to COVID. And on top of that, we have all these probably unintended consequences of rescue measures that will have a bearing on how real estate markets function. So I'll stop here, but just putting these issues on the table, which I think we'll all need to think in our different areas of work, because they will shape the way real estate markets operate over the medium to longer term. So great to have Richard and Gyula sharing their thoughts with us as well on how they see those evolving trends affecting the way the segments of the markets in which they are operating. But thanks, Danae. I think that covers a lot of our chapter, doesn't it?
Yes, thanks, Luiz. It's a very good introduction, and thanks for putting these issues on the table. Maybe before I move on to Richard, just a couple of follow-up questions on what you've said so far. So your trend number 2 in terms of teleworking, do you see that also affecting kind of regional dynamics? We saw from Daniele earlier the change in housing prices in different countries in Europe and different regions. There is a lot of thinking going on about can people even work in and live in different countries? How do you see that affecting the regional disparities? One question, and then you also, your third point, raised the issue around sustainability and of course the kind of underlying discussion of energy efficient housing and real estate. How do you see that forming part of policy going forward?
Very great questions. And I think that on teleworking we are all speculating. The key issue is how prevalent will it be? But the point that you raised is a very important one. We were seeing already trends, people moving out of city centers, people who don't work obviously in activities that require a lot of person-to-person interaction. So there is that demand shift is already taking place. We are seeing that reflecting prices, right? You see the differentials between the central business districts, residential areas in city centers, as opposed to the peri-urban areas around our metropolitan areas. That's already happening. So that kind of dislocation of demand, if it persists, it will change the way the market supply and demand will interact in the future. I think there will be, when there is, when the worst of the crisis is over and we come back to some sort of normal life again, I think part of that will be, or the pendulum will swing back, if you want. But there is, I believe, some underlying trend that will be there. There will be more telework than there used to be before. Probably not to the extent we have now, but there will be that. On the issue for sustainability, I think there is a great opportunity now that many countries, not least the EU, are thinking very hard about linking their recovery plans to sustainability considerations, how to improve energy efficiency being one of them, how to make sure that the recovery supports this effort towards a less carbon intensive economy. So it is both an opportunity to act on that front, to make progress where it has been difficult in the past, but also to make sure that when that happens, that it's happening in a way that is consistent with all those trends that we are seeing, shifts in demand that can be semi-permanent or more permanent, and how supply responds to that. So it's a golden opportunity for all of us to work more on energy transition, and I think we've been in this group thinking very hard about that, about how to give more impetus to efforts in that area so that we can do both. We can have a recovery that is stronger, but also much more aligned with our longer term objectives of decarbonizing our economies.
Thank you, Luiz. Let's move on to you, Richard, now. How do you see these trends in terms of the structural changes that we're seeing because of COVID-19, because of how people start to react differently and engage differently with the housing market, both commercial and residential, and these impacting the future, both on the sustainability angle, but also the more kind of core areas of the housing market?
Thanks, Danae. I think Luiz set the agenda extremely well, and what I'd like to say is in terms of comments on a couple of the points that Luiz said. The first point that Luiz made regarding the forbearance of mortgage costs and all of the schemes and the potential for that to be a disincentive for investment in a lot of countries. One thing that I think we've perhaps not focused on enough is forbearance of rental payments. In those countries where you have a more significant non-owner occupied market, the forbearance of rent payments and the moratorium on evictions and court actions against tenants has been understandable and an obvious response, but it hasn't necessarily been symmetrical with the forbearance on the borrowers underlying, the landlords underlying financing costs. And I think there are a lot of cases where landlords have perhaps just capitalized interest payments and lengthened the duration of their mortgage or increased the amount that they owe, and having the offsetting amount completely written off. To me, this feels like a massive disincentive for people to participate in buy-to-let market going forward, which is obviously very significant in some countries, immaterial in other countries, but one of those unintended consequences. A second point that I think I'd make, and it's again to do with that payment moratorium, is that some forms of financing mortgages react to that very differently. I spent a lot of my time looking at the differences between covered bonds and securitizations as ways of financing residential mortgages. Securitization really lives and dies on its ability to take risk out of the balance sheet of the originating bank and pass it on to other investors. Now, when you have payment moratoria, whatever, like this, have you really transferred the risk of the underlying assets from a bank risk management point of view, from a bank capital point of view, if a government intervention such as this can come in and say, we're adding to the risk? Covered bonds are, of course, a revolving pool of assets. If it starts to become an issue, we take the affected mortgages out, we replace them with better mortgages. You can't do that in securitizations because you've really got to draw a line. Now, From all the numbers that I've seen about affected countries, it's not material to the structure of securitizations yet. But payment moratoriums are one of those ideas which I think can't be uninvented. We're talking about it in the light of this particular threat. Are we going to talk about it in the light of other kinds of threat, idiosyncratic risks in future? And is that going to fundamentally change the extent that you can actually model and quantify risks in securitization transactions? Now, I'm an advocate of covered bonds, and I don't wish to diss the securitization market, but I think it's something we need to consider from a policy perspective. And I think the final point I'd like to make regarding the point about how we use property. We all know anecdotally lots of people who have bought houses. You know, Daniele made the point very well about house prices in capitals and house prices in the rest of the country. We all know people who have struggled to buy small houses in expensive places who are now thinking, well, why do I need to live in central London? Not a nice place to live, really. It's an expensive place to live. If I'm spending all of my time telecommuting, why don't I do it from somewhere nice? Now that's fine and makes sense and is a sensible trend. We not need to upgrade our broadband and whatever, but the process of going from one state to another is going to create some significant problems, in particular for the banking system in terms of NPLs. An awful lot of people are going to be saying, well, the housing stock and where the revenue is earned are now no longer disconnected. What the overall effect on house prices is going to be is difficult to say, but breaking it down, and I really want to see Daniele's presentation from next year about capitals versus the rest of the country, is house prices are going to fall in the areas where they're inflated and probably rise in the area where they're low, and that is going to have a bigger impact on NPLs at the margin, I think. Those are my only kind of comments, and I think, Luiz, thank you so much for setting the agenda and encouraging the thoughts on that.
Thanks, Richard. Very interesting. And just to pick up on your last point about NPLs and the banking sector, I mean, as you say, it's something that we will all be looking at for next year. But how do you think policymakers can kind of react to that in advance, or anticipating something like that to happen? What may be some policy changes to already make, perhaps to create incentives? I mean, some of these trends are difficult. It's a natural direction, and maybe we don't even want to oppose them or create incentive to stop them, but how can we make that transition from one stage to the next more smooth?
Yeah, well, we can avoid NPLs very easily by payment moratoriums. That's very easy. It stops the NPLs becoming apparent in this year's numbers. You know, as I used to say when I was a banker, a rolling loan gathers no loss. Going forward, clearly the NPLs are going to have to be addressed by capital market solutions. The good news about that is we've developed quite a lot of capital market solutions for the previous wave of NPLs. Is this going to be different in terms of the dynamics, in terms of the acceptability to the market? It's very difficult to tell. We do have enormous capital buffers in the banking system. They are predicated on the last crisis, which was about making the banking system as stable as possible. And I always say there's a balance between stability and growth in banking. Perhaps part of the answer is to reduce not just counter-cyclical buffers, but overall capital buffers, whilst people work out the NPL problems that are a result. I think that the one worrying thing that I've seen from Commission is a reluctance on the part of Commission to make synthetic securitizations of NPLs easier to do. I don't want to get into the nitty-gritty of it, but I think we need to, when we look at securitizations, we need to make things as user-friendly as possible, and yeah, we need to find a way of transferring the losses which are there, even if we're slightly in denial of them at the moment, transferring them to investors who can price them more accurately.
Great, thank you, Richard. And let's move on to last but not least, Gyula. And you've written a chapter in the publication itself setting out the developments in Hungary. We also saw in Daniele's presentation earlier, Hungary really being an outlier. And he mentioned also how the rise has been double in the capital than elsewhere. walk us a little bit through what you've written in the chapter in terms of the measures we've seen in Hungary. We've heard from Richard about the moratoria rules, etc., and there were some of these in your case. And also the developments that you've written about in terms of the green finance and sustainable finance, where we saw a green issuance in 2020 in the country, and also the work that your own bank is doing in that area.
Thank you, Danae. And first of all, I am just for introducing myself. I work with Paul and Daniele in the Research and Data Committee. And thank you for the possibility to speak about Hungary, which, as you have seen, is not the greatest mortgage market, but at least we are part of the European mortgage universe. First of all, a few facts about Hungary. We have 9.8 million inhabitants with 4.5 million dwellings, but more than 90% of the dwellings were built before 2000, which is now an opportunity, because we will speak a little bit about green finance, but this is a fact that the dwelling stock is rather old. House price growth was very high in 2019. This was actually the highest in Europe. And Daniele mentioned that even highest growth was experienced in Budapest. So now those people having dwellings which they bought for Airbnb or letting out for foreigners visiting Budapest, which is a nice city, now are in big trouble, because these apartments are actually empty. We have a very high home ownership ratio. This is typical for Central Eastern Europe. It's actually 86%. On the other hand, the housing loan to GDP is relatively low. So it's one of the lowest. It's only 8%. And as also Daniele mentioned, we had a quite good growth in 2019, GDP growth of 4.9%. But in the second quarter of 2020, there was a drop of GDP year on year, a quarterly drop with 14.5%. And it was also mentioned that we have mostly fixed rate mortgage loans now. So from all the new issued mortgage loans, less than 3% was with variable interest rate. Now let's speak a few words about the COVID situation. So we have the central bank has introduced, the central bank and the government introduced the moratoria, which was from March until the year end. And this moratoria makes it possible for private individuals and also for corporates to suspend their payments. And we had a so-called opt-out system, which means that those people, individuals or corporates who can pay, they had the opportunity to continue, but as an initiative, it was given for all the debtors, for example, for the individuals, individual mortgage debtors, which is, I think, a specialty for Hungary. And now the moratoria has been extended by another 6 months. So it will be until June next year, but this time it will be differently handled. It's only available for people, for families, for pensioners, people working in civil work, and also for corporates only if they had a drop in their income and they have financial difficulties. So for the second part of the moratoria, this is different. We are a mortgage bank, so for the mortgage bank, it's important that in the capital markets there were also disturbances, and the central bank was helping with a mortgage bond program, which meant that the central bank was buying on the auctions of the mortgage bonds issued, so it helped the capital market. But an important thing happened in November. So in November, the central bank announced that now they will stop their mortgage bond program, and in the future, they will buy, at least for next year, they will buy only green covered or green mortgage bonds. So there is a swift at the central bank's policy. As far as the banks are concerned, it was already mentioned that banks have accelerated their digital programs. Just to mention a few things, that in Hungary in March, the instant payment system was introduced, which means that all the commercial banks must transfer the payments within 5 seconds, which is quite special, I think. I mean, we are one of the forerunners in this, because there are many countries where this system is not yet in place. I think in the COVID situation, it helped to avoid cash payments, and it was also good timing because it started in March and it's functioning quite well. Then there are, of course, online banking programs. The banks are very innovative, so people don't have to go to the branches. We also introduced a lot of new products. What our bank is concerned, I remember that in the last crisis in 2009, in our mortgage bank, we have created our own house price index, which has been working in the past, and still we were thinking of going to new areas. So this time we are working on an AVM product, so automated valuation method, because in the mortgage lending it is also difficult to do the on-site valuation. For different reasons, we have to revalue our portfolio due to the COVID. The price or the value of our loan portfolio is changing rapidly, so we cannot wait a year or even more than a year to revalue the collaterals behind our mortgages. So we think that AVM is an important tool, and we would like to offer it because we are a refinancing mortgage bank, so we have 10 partner banks. We are not originating our own mortgages, but we are issuing mortgage bonds and we are refinancing other banks. So this is a specialty for our bank. And well, I spoke about the innovations. And the third thing that we already were thinking about issuing green mortgage bonds, but in Hungary this started a bit later than in other parts of Europe. But the COVID makes us to really turn into this direction, and especially that the central bank is also pushing the green finance and the green mortgage bond issuance. So if you look at this section, green finance in the Hypostat, Hungary is not yet in, because we applied to energy efficient mortgage initiative in October. Unfortunately, the statistics were representing a September status, but actually we are working really ambitiously also with the other banks. This work is going in the banking association. We are trying to work out the green covered bond framework for Hungary, and we would like to be among maybe the first or the second issuer, because there are actually 2 mortgage banks who are working on this. So I think just to close my part, pandemic has really made life more difficult, but I think you always have to find out some messages and some directions for the future. So we are working for the new products for the future, and I think green mortgage bond is something like this. So thank you very much. It was a quick summary from a banker's and the mortgage banker's point of view, how we react to the COVID situation.
Thank you very much. It's great to get a kind of more in-depth view after we've set the scene for what's happening in terms of the broader trends. We have just a couple of minutes left, but maybe just to follow up on what you've said, and on the kind of green mortgages efforts and the green finance side, how do you see the developments on the kind of data side and the EU taxonomy for green finance impacting the acceleration of this market, both in Hungary and elsewhere?
I think that this is absolutely in the center, this topic. And I read the report of the Climate Bond Initiative from 2019, and it was clearly mentioned that Europe is the #1 when you compare the regions. So I think Europe has made the biggest increase last year in green bond issuance, not only mortgage bonds, but also green bonds. And North America and Asia Pacific comes only after. And I think that this is also shown that in the European Union, the green topic is very much discussed. In Hungary, our central bank has joined the advisory council of the energy efficient mortgage scheme. So we can say that also our regulator is part of the green thinking. And we as bankers, we see a chance to join as soon as possible. Personally, I am also convinced that this is good I am an old man, but this is for our next generation. This is something good. So, and I have a lot of young colleagues, so they are also quite enthusiastic to work on this topic.
Great, thank you. And I think this is a very good bridge to the next panel, which is focusing on sustainable finance. So I'll hand over to Jennifer now to take us through that. But thank you very much to all the panelists. And I unfortunately have to go, but I think some of you may be sticking around. So if there's more conversation or discussion, and if anyone has questions on the chapter that Luiz and I wrote, please do get in touch. But great to be here today, and good luck with the rest of the day.
Thanks, Danae. Okay, so let's move on in the interests of time. That was indeed a great bridge to this panel, and also actually already Luiz made, I think, a great bridge to this panel earlier on when he mentioned how the crisis that we're experiencing at the moment is a golden opportunity to also focus on sustainability aspects, work on the energy transition. And incidentally, this is an observation which has been made by heads of government, MEPs and other institutions in the wake of the ongoing COVID-19 crisis. So that was really a great introduction to our Energy Efficient Mortgages Initiative, its relevance today, and our panel discussion. Now, of course, when we launched the initiative 5 years ago, the fact that we would be 5 years later in the grip of a health crisis was unthinkable. And at that time, the Energy Efficient Mortgages Initiative was intended very much as a response to the challenges of climate change and the need to stimulate private finance to support the transition to a more sustainable economy. And so now today, 5 years on, we find ourselves luckily with one of the most concrete and I'd say timely market initiatives, which can help to make the recovery from the COVID-19 crisis a green one, but also can constitute a direct response to the next generation EU vision, the renovation wave strategy, and the EU Green Deal. The objective of the Energy Efficient Mortgages Initiative, as I'm sure most of you, if not all of you, know, is to design an energy efficient mortgage product and infrastructure, including an energy efficient mortgage label. And I'll hand to Luca in one moment just to say a few words about the label. And the intention really is to stimulate and help finance the improvement of the EU's building stock. Our recent efforts, given the urgency of the challenges, have been very much focused on operationalizing the market, so taking everything we've done so far over the last 5 years and trying to make the market happen as soon as possible through the label, through market demonstrators, but also, and very importantly, through underpinning the business case for lenders, which will in turn, in our view, drive a virtuous circle of benefits for all stakeholders in the chain and, of course, the real economy. And so at the heart of the business case is the assumption that building energy performance reduces credit risk by reducing PD, so probability of default and loss given default. And this could translate into preferential capital requirements and, as I said, could drive this virtuous chain of benefits for all stakeholders. And this is where I would, in one moment, like to bring in Francesco and Max, who, through the Energy Efficient Mortgage Initiative, have worked on substantiating this link between credit risk and building energy performance in order to provide us with, if you like, the building blocks we need to develop the business case and potentially reach out to the European institutions to have this reflected in the prudential framework. Before I hand over to Max and Francesco, I'd like to give Luca the floor to talk a little bit about the energy efficient mortgage label, because it's very timely. We're working on this at the moment. And so Luca, please, if you'd like to say a few words.
Thank you, Jenny. Yes, few words, because we as an industry body, we are thinking how we can concretely help our banks to manage this transition and trying to be useful to the plan of the European Commission, as Gyula said, the next generation, thinking about our kids, our children, and also how we can leverage a market support to support the renovation wave. The Commission has a very ambitious target, which is renovating 35 million of dwellings. Well, the market can do something, and we believe that we should help the banks. So, Gyula, no worries. You are still in time to be the first energy efficiency mortgage label bank. So, if you want to join us, I mean, I will give a bottle of champagne to the first label. So, if you want, it's a pleasure for me to send this to Budapest. Unfortunately, I cannot come in person to Budapest, but I would like to show you the website, which has been presented yesterday to the pilot phase banks. We are still consulting. We want to make sure that the website is responding to the needs of our banks. But what we would like to create is a group of banks which are proposing an alternative to the European Commission for a special privileged treatment in terms of prudential areas for banks to be eligible for this prudential special treatment. The website is indicating how banks can enter and use a specific label for consumer, investors, and lenders. Of course, we have selected 3 nice areas, and I would like to, which is a Nordic picture, Amsterdam, a southern, which is Pisa, and then we went to Krakow for the Eastern market, because we want to represent the entire European market. What is the challenge that we have? Taxonomy, how it was published, is really challenging the market to enter in this space. The Taxonomy Delegate Act is identifying a too ambitious area, which will not allow the mortgage market to have a gradual approach. So the energy efficiency mortgage label wants to be an alternative for banks. We are opening the consultation. We really hope that by June, we will have all the 66 pilot phase banks part of this initiative, representing that Europe can be united, integrated in challenging the 2 major challenges, that is providing a better future for our next generation and a better house where we live and now we work. I will finish here, Jenny. I don't want to steal too much time from your panel. And I think that the analysis done by CRIF and Foscari is very relevant, because it is the evidence that we were looking for to guarantee to the energy efficiency mortgages a special prudential space in the European regulation. Thank you, Jenny. I give you back the floor.
Thanks, Luca. Perhaps Daniele, you could go back to the slides now. Thanks very much. And I'd love to hand over now to Francesco. The slides will be arriving in the moment. Francesco, Daniele is in control of the slides, so he will help you through. So please, Daniele, Francesco, the floor is yours.
Thank you very much, Jennifer, and good morning, everyone. My name is Francesco Portioli, and I'm representing here CRIF. Let's say that in the project, EDA project, we carried out the correlation analysis between energy efficiency of buildings and mortgage default, credit default of the contract. And the very first question we're starting from is, does a negative correlation between energy efficiency and mortgage default risk exist or not? And the answer and the signal we receive from the performed correlation analysis, it is that yes, it does. So basically, as I said before, we carried out a correlation analysis proving the existence of a negative correlation. So the greener the asset, basically, the lower the credit risk. We used a portfolio. I will introduce the portfolio in a minute, but basically we use a portfolio of Italian mortgage contract. It has been provided by CRIF, and where the energy performance information, APC, has been added to a traditional risk estimation model, so scoring model basically. And what we gain is statistical significance. So the relation between energy class and the risk is robust. we also had the chance to communicate with pilot banks willing to participate in the analysis. So we also gathered portfolios from pilot banks, and we also had the chance to have an overview in terms of data quality analysis. I will present it in a minute again. Next slide, please, Daniele. And the other again. Okay, perfect. Thank you very much. So first of all, two main activities are the definition of a legal contract with pilot banks, again, willing to participate in the analysis, and the definition of a data template in order to perform the data gathering activity. What kind of information we requested to pilot banks? Basically information about the borrower, the property, the contract, and credit performance of the contract again. A data framework, first of all, let's say data framework has been created starting from the master template. We identified some key variables in order to perform the correlation analysis, and also a legal contract. So let's say a legal framework in order to regulate all the data privacy issues was defined with pilot banks. Overall, let's say that we undertook legal negotiation with 7 Italian pilot banks, covering around 90% of the national market, and also 2 other additional credit institutions operating in Europe. Next slide, please, Daniele. Thank you. Again, we identified 4 many informative sources, so borrower's information, property information, information linked to the contract as the date of origination, and information about the credit performance of contract over time. So starting from the very first one, so borrower information, we asked pilot bank to provide us, if possible, information about social demographic profile of borrowers, like age, working experience, marital status, and so on and so forth. And as you can see, overall, the data we analyzed and we gathered was very satisfactory in terms of information about the borrower. Secondly, if we move to the property information, we ask about information about property, about the properties, so cadastral information, the commercial value, and energy performance information linked to the buildings. And in this case, as you can see, especially regarding the energy performance information of the buildings, we do not gather all the set of information that we expected at the beginning. Moving to the information about the contracts, the date of application, we ask for many variables or information about the, for example, purpose of the loan, like purchase or refurbishment term, applied interest rate, the type of interest rate applied for the contract, LTV. And why, if you consider the credit performance, we ask basically for the payment history of the contract, so any signal of delinquency or evidence of the recovery process. In this case, again, we gather information starting from some portfolios of pilot banks, and the qualities was quite satisfactory. Next slide, please, Daniele. Okay, thank you. Again, just to stress the fact that we gather some very important data set, and we performed a data quality on this data. We applied a traffic light approach. So basically, as you can see, we have 3 different colors. The green, if the information was available in all the analyzed data set. The amber, if the information was available only partially, so only for some of them, and red, information not available at all. So we also provided more details in deliverable 5.2 of the EDAP, but this is just, again, to give you the sense of what we gather from pilot banks. In terms of borrower information, again, and the contract information, as you can see in the next slide, Daniele. The collateral information, and again, the credit performance. So I don't want to spend too much time on this. Next slide, please, again. Okay, thank you very much. So due to COVID-19 and due to timing, so we needed to conclude, basically to end our EDAP with the project, we decided to use a portfolio provided by CRIF. So it is based on residential mortgages. The source again is CRIF, and we started from a portfolio of 344,000 of loan mortgages in the period 2010-2019. We also add the APC information that was made available through our CRIF real estate branch. So adding this source of information, we end up with around 145,000 of record. Again, we add also another very important piece of information, that is the borrower credit score. And finally, applying some additional filters, we end up with around 73,000 of record. And this is the let's say the base of our for our analysis. Again, we had the chance to analyze additional portfolios. And in this case, I'm talking about the one from the Portuguese market, the Belgian market, but they were too small for the analysis. Max will provide you more insights in a minute. Next slide, please, Daniele. Okay, so what basically here the question is, what kind of information we use in order to perform the correlation analysis? According to the contract information, CRIF does not hold information about interest rate margin, for example, but nevertheless, the loan amount, long-term payment frequency, date of contract origination, for example, they have been included in the dataset. According to the borrower, we used information like the age of the borrower, both as of today and as of the date of the origination of the contract. Information about the residency of the borrower and the nationality, of course. According to the properties, again, thanks to the real estate expert valuers of CRIF real estate branch, we had the chance to gather information about geolocalization of the property, physical condition of the property, just to give you an example. And finally, in terms of credit performance, we inserted information about indication, let's say, of arrears in payment for if present, default, date of default, while others information that have been identified at the beginning, like foreclosure or price sale, they were not been added to the final data set. Next slide, please, Daniele. So I'm going to give you the floor to Max just to present the results of the regression and some descriptive statistics. Max, the floor is yours. Thank you very much.
Thank you, Francesco. Good morning, everyone. So what we did here is we applied two different methodologies to analyze the data set. We used the logit regression, where we were modeling the default probability, and the Cox proportional hazards model, which is borrowed from the medical literature, where people are usually investigating the hazard of patients' risk of death. In our case, it's the risk of default. And the variables that we are using is a default variable, which is defined as 1 if a mortgage is in arrears for at least 90 days and 0 otherwise. And the energy efficiency variable is equal to 1 if a building has an EPC rating of A. And we also tried A or B, but here we will show you only results for the more restrictive definition of A. And the control variables are mortgage variables, household, dwelling, and market controls. Daniele, can we go to the next slide, please? And the next. Yes, thank you very much. The data set is quite young. It starts in 2012, so the mortgages were issued in between 2012 and 2019, and as you can see, only in 2014 the number of mortgages is kind of quite significant. But if you look within each bar chart, you will see that at the bottom, the blue and the orange bars indicate that for each origination year we have some A and B rated mortgages, indicating that still we have a few mortgages to have a look at and to run the analysis. Daniele, can you go to the next slide, please? This is a distribution of the defaulted loans. As you can see, it's a pyramid shape, showing us that of course in 2012 we have less more defaults because there are just too few loans, but also in 2019 we have just a few loans, but this is a technical issue. Of course, the loans need some time to default. So if you take up a loan today, you're quite unlikely to default tomorrow, right? It happens rather in a couple of years. So we have the sum shape here, but within each bar chart, you again can see that we have some A and B rated buildings among the defaulted loans. Daniele, next slide, please. On average, our loan is about 130,000 euros high, and it represents a medium household in Italy. The next slide, please. The buildings are constructed mostly after the 1950s, as you can see here from the distribution. Next slide, please. We have quite a few slides. This is why I'm jumping a little bit quicker. And this is a distribution of the individual ratings in the data set. So the ratings are going from A to G, and in general, we have about 7% of A-rated buildings in the data set, of which 0.79% defaulted. And Daniele, can we go to the main regression results to the table? Can you go further? Yes. So this is the most interesting part of our analysis. Here we are presenting the logit regression results with different model specifications, from the least restrictive, it's model 1, going to the most restrictive model 6. And if what we are looking at, what's most important is the first row, the EE variable that is marked bold. And what you can see is that the coefficients are negative and significant. The stars indicate that they are significant, statistically significant. And if you look at the bottom, we are providing an overview of control variables that we were using in the regression. So we are at the bottom, you can see it says dwelling controls, yes or no, household controls, market controls, mortgage controls, regional fixed effects, origination year fixed effects. And so starting with model 1, you can see that in model 1 we were just using mortgage controls, which were the borrower's credit score, loan to value, and the loan term. And the coefficient was negative and significant. And then in model 2, we were adding dwelling controls. As you can see, it says dwelling controls, yes. And with model 3, we added household controls, which is the borrower age. The coefficient was still negative and significant. And model 4, what we added is the origination year fixed effects. This is what I was saying before, that there is also some technical reason. There's some technical reason for not defaulting. If you have just recently borrowed the money, then you're less likely to default. So we are taking account for this. And in model 5, we also take into account the regional fixed effects. So we differentiate between 5 different regions in Italy. It was Northeast, Northwest, Central, Southern, and Islands. Just to take into account that maybe the residents' behavior differentiates between different regions, but still the coefficient is negative and significant. And the last but not least, in the most restrictive model 6, we are also adding market controls like inflation, unemployment rate, and regional house price index growth. And in model 6, the coefficient of minus 0.36 corresponds to a marginal effect of 37 basis points. So this means that the probability of default is reduced is 37 basis points lower for mortgages that were issued on A-rated buildings compared to the other ones. Can we go to the next slide, please? In this slide, what we did, we took model 6, the most restrictive one, and then we estimated the model without the energy efficiency variable. This is the top part, and then we calculated the predicted default probabilities that the model would predict without using the energy efficiency variable. And the average default probability would be, if you look at the table, it would be 0.95% for A-rated buildings, and the probability of default for non-A-rated buildings would be 1.33%. And if we would and when we use the model 6, including the energy efficiency variable in the model, and re-estimate the probabilities of default, then we observe that, this is the lower table, we observe that the mean probability of default for energy efficient mortgages decreases to 0.70, while it stays almost unaffected for non-energy efficient buildings. At the average predicted probability is 1.35%, as you can see in the graph. Additionally, what we did, we computed the area under the ROC curve, which indicates to what extent a model is good at predicting defaulted loans, to what extent a model that predicts a defaulted loan actually correctly predicts it, that the prediction is that the loan actually defaulted and the non-defaulted predicted loan actually does not also does not default. And what we observe here is that the area under the ROC curve is improving when we add the energy efficiency variable, meaning that actually including the EE variable improves the model and in predicting the defaults. Next slide, please. We also ran an empirical analysis on the subset for the year 2017 and to 2019, assuming that the data became better as the time progressed. And can we go to the next slide? And the results are quite similar. The coefficients are still negative and significant, and the marginal effect on the probability of default is even larger. In this case, it's 53 basis points for the most restrictive model. And can I go to the next slide, please, Daniele? Yes, so just to summarize, we were focusing on the Italian mortgage market, and the origination year was 2012 and later, which means that the data set is quite young, but still the results hold, and they hold for both methodologies, even though we presented just the logit regression results. They also hold for the Cox regression model, and an additional analysis that we ran but didn't present was that also the degree of energy efficiency matters. So even moving up a few notches from a G-rated building to a C-rated building, for example, also reduces the is associated with a lower energy efficient, lower probability of default. Sorry. And yeah, and as Francesco said, we were also investigating the Portuguese and the Belgian data set, but they were too young, and we are quite confident that the time will remedy it, that we will be able to also utilize these data sets in the future. Thank you very much.
Thank you very much, Max, for a very and Francesco for a very comprehensive overview of what is, in our view, a very significant piece of work, which confirms a long list of analysis in this direction over the last 15 to 20 years. It is a very timely piece of research because, as many of you will be aware, the European Banking Authority has also been mandated by the European Commission to analyse the potential prudential treatment of exposures associated with ESG objectives. So they are now conducting a big data collection analysis, data collection exercise, and they will be analysing this data in the next couple of years. It's a longer term exercise, but also this analysis, we believe, is significant in the context of the current discussions around the implementation of Basel III into EU legislation. The European Commission is under pressure to green legislation to further the sustainability agenda in the EU for all of the reasons that we know. So this research has been and remains very significant. The intention is, as much as we can, to continue this work through our EU projects, to continue the data collection exercise, to deepen the research, to make the research as robust as possible. So again, our thanks to Francesco and to Max and your respective organizations for your great support here. We have, Daniele, do I have 2 minutes left to ask if there are any burning questions? But literally we have 2 minutes, so I check to see if there are any, if there's any interest in asking a question. I don't believe so. So Daniele, I hand back to you. Thanks very much.
Thank you, Jenny. Now we go to the next panel on trends and challenges in the housing market, moderated by Richard Kemmish and with panelists Max and Christine. Richard, the floor is yours.
Thank you, Daniele. To answer that last one from Jenny, yes, I do have some questions, but I didn't want to delay this presentation. So if I can, I'm going to ask Max a couple of questions at the end. So a very long time ago, way back in February, when we were still allowed to travel and still allowed to have beers and whatever, I had a nice burger with the EMF team. I was asked a great question. As a long-time avid reader of Hypostat, I was asked, what would I like to see in some articles? And what I'd like to do now is present a couple of the articles that came out of that conversation, or rather ask the authors to do that. One of those is about affordability. Now, this was a topic which has been of growing importance over the years. Daniele earlier quantified that, but I wanted to look at it more from a policy perspective. COVID has obviously thrown that into much more sharp relief. It's suddenly become a lot more urgent issue. Before we come on to that, though, I'd like to talk about another topic, which is very important to me, very close to my heart, and that's convergence in the mortgage markets. Our friends in Brussels spend an awful lot of time talking about convergence of a lot of things around mortgage finance, covered bond regulations, securitization regulations, capital markets union. But with the more I travel in Central and Eastern Europe, which is something I do as much as I can, I realized the vast differences across Europe in the raw material. 7 trillion euros of mortgages outstanding, but really, really different in different countries within the Union. Clearly, history has a lot to do with that. Clearly, culture has a lot to do with that. But even accounting for that, when you look at the stats at the back of the Hypostat, you see some very odd pictures. Julia mentioned earlier that the Hungarian mortgage debt relative to GDP, I think he said was 8%. Compare that to, for example, Slovakia, where it's 30%. Now, I don't see huge structural differences between those two economies. Sometimes mortgages do converge. Over the course of a decade, the Polish mortgage market tripled in euro terms. It's a phenomenal growth rate, but other mortgage markets in the area barely changed at all or shrank. And I've never understood that. People tried to explain it to me culturally, but I thought I'd much rather ask someone very clever, someone who understands the quantitative aspects of it, to try to look at it. So very happy to be able to ask Max a very simple question with a very complicated answer. Max, are European mortgage markets converging?
Thank you, Richard, for this nice introduction. Yes, it seems that they are converging, but it's quite a difficult question, to be honest. Yes, and the deeper you dive into this question, you actually start yourself asking, so what are the underlying drivers of convergence and what's happening across Europe? And what we did, it's a joint work with Monica Biglio from Foscari University, and yes, we were asking ourselves, are European mortgage markets converging? And you might ask yourself, so what means European, what means converging, and over what time? So what we did, we analyzed the data provided by EMF. So this means that we were focusing on all European countries, but also we were looking at a subgroup, the Euro area countries, and differentiating also among regions. We're focusing on the Eastern European, Southern, Western, and Northern European countries. And what means convergence? Convergence means that variables become similar in some sense. Maybe they move together in a similar way, or they are heading towards some equilibrium value. And here there are different approaches how to measure convergence. So you can either measure the co-movement and synchronicity of a variable, or you can also measure whether the variables are converging to a certain value, towards a certain value. And what period? Well, the period is restricted by the data. We were looking at the mortgage variables themselves, which are available at quarterly frequency starting from 2007. And we also looked at some economic variables, which are available only at the yearly level, but for a longer time periods, beginning with the year 2000. And in the first part of the article, we were focusing on the mortgage market variables, and we selected three main variables: the mortgage market growth, mortgage rates, and house price index growth. And the three charts that are the three graphs that are presented here, they're very small, but they are just to show you how the dynamics look like. They are from the article showing you that the left graph indicates that it's the mortgage market growth. That mortgage market growth was synchronized among Southern European countries, which is the green line that is above all the other ones, and it was improving in the euro area beginning with the year 2017. Excuse me, someone has the microphone on, so everyone can hear that person shuffling some papers. So please, can you turn it off, please? Thank you. And then there is a striking line at the very bottom, which represents the Northern European countries, which seem to not move at all together. So they are fully asynchronous in this respect. If we look at the mortgage rates, we can see a hump shape. This is also what kind of Daniele's presentation was indicating. The mortgage rates were decreasing over the past decade, so they were moving in the same direction, which resulted in a very high correlation among themselves. But at some point, about 2017, they hit a plateau, and they didn't move neither up nor down, and there the co-movement decreased, and this is shown by this slide down starting from the year 2017 to 2020. And if we look at the house price index growth, we can observe that especially the Western European, the Eastern, and the Northern European countries are kind of regaining a co-movement pattern. And yeah, and in the second part, we were looking at the economic variables, and we used a beta convergence approach, which is usually employed in the growth literature, macroeconomic growth literature. And what we found is that yes, most variables are actually converging according to this measure. And we can observe that low GDP economies grow faster than the bigger ones, so they are kind of catching up with the bigger ones. And also the low mortgage debt to capital countries are catching up, and especially in the euro area, meaning that being a eurozone member has some benefits in the sense that your pace of convergence is higher than being outside the euro area. And the last part of the article, we investigated the links between economic and mortgage variables by running a regression analysis. And the main finding was housing affordability issues that seem to be prevalent, or we are observing some hints of housing affordability issues in the sense that mortgage market growth seems to be higher in low GDP economies in times of high house prices, and this is irrespective of the household income. This means actually that people have to take up higher mortgages to afford themselves to buy a dwelling without actually having the appropriate increase in their incomes. Additionally, what we observe is that interest rates are high, especially in small economies with low occupancy, where the occupancy rates are low, and also again in low income regions, which might mean that maybe there's some low competition in certain regions, but we haven't explored this question fully. So this might be an idea for the next analysis. And can we go to the next slide, please, Daniele? Because Daniele, thank you very much. And we come here with this, we come to the outlook. So we observe a trend in economic and mortgage market convergence. Well, if you look at the mortgage market convergence, that you can see that there is a time varying pattern, especially being in the euro area helps. And what was striking that I have not yet reported is that one variable did not converge, and it was the number of bank branches. Actually, the bank branches, physical bank branches, were decreasing across Europe. About 30% of bank branches were closed over the last 10 years. So the physical presence of branches declines in importance. And the question is, for the future, do banks actually capitalize on this development, and are they expanding their cross-border services, since it's now becoming much cheaper for them just to open a website and offer the services online than opening up a net of physical bank branches. And this comes in with bank competition questions, since we are observing that maybe competition is lagging in certain regions. Do banks capitalize on the digital transformation, and are they going to increase competition in the long run in the regions where competition is low as of now? Housing affordability concerns are, of course, a huge issue and question. What are the consequences for future mortgage market growth? Because we had this in the first panel. Currently, there are the moratoria on mortgages, but for how long will they will they be available, and what will happen afterwards if the economic recovery is slower than expected? And last but not least, we observed that in one of the regressions, not in one of the regressions, but in general, in the regressions, we observed a negative correlation between inflation and housing transactions. And the question is, given that we currently have this expansionary monetary policy stance of the main central banks, we will probably expect a high inflation in the next couple of years. And inflation, I assume, has two different effects on housing transactions and in general on mortgages, in the sense that when inflation increases, probably dwelling owners want to transact and capitalize on this development. They want to sell their buildings. But on the other hand, if the inflation expectations are high, so if the dwelling owner expects even higher prices for their dwelling, for their dwellings, then probably they will start postponing the transaction, which will result in a reduction of the overall transactions. And this is so there are two opposing effects, and currently what we observed in this analysis, so that the net effect was negative, that the inflation was actually associated with lower housing transactions. And the question is, going forward, how this will develop, and yeah, we should probably focus on it in the next analysis. Thank you very much.
Thank you, Max, for the presentation, and thank you for the article. as I expected, to be completely honest with you, it raises as many questions, it raises more questions than it answers. And I think that this last slide has a lot of topics that we could go on about in great length. A couple of observations just from my side before I throw it open for any questions. Your point about being in the euro area helps the growth of mortgage markets, I think is particularly interesting in the light of both Croatia and Bulgaria joining ERM2 over the course of this year. Bulgaria in particular, I think, has the smallest mortgage market relative to GDP of any of the EU countries. So it'll be very interesting to see if that's going to drive growth in the Bulgarian mortgage markets. And I think the other point, and there's obviously a general point about when you use historical data, whether you can extrapolate the trends into the future, is this point about the bank branches. And that is a topic that I have never really considered before. But as one of the implications of COVID, I suppose, is moving away from the bank branches and whether that's going to start to become a changed relationship going forward between mortgage origination and physical branches. Random observations. Can I throw it out to everyone listening? Do you have any questions for Max? Everyone's gone very quiet. We're going to have a general question and answer session at the end. So if you do think of questions, then perhaps we can bring them up then. So before that, though, I'd like to move on to the other article that I'd like to discuss. And as I said, I think this is something which has been important for a very long time, mortgage affordability. As we've gone through the course of the year, it's become more apparent that it's going to be relevant because of COVID, because of changes in the way that we use our homes, changes in monetary policy. We've got probably lower interest rates for longer, which is always going to be inflationary for house prices. And frankly, it ties into the buy-in for the political agenda. If people can't afford their houses, it's a fairly major contributor to whether they're going to buy into being able to upgrade their houses for more energy efficiency, whether they're going to be more transparent and more mobile as a labour force. So I think it's a vitally important point. Daniele has already touched a little bit on housing affordability from a quantitative perspective, but I'd just like to ask Christine Whitehead from the LSE if you could just talk about it more from a policy perspective.
Okay, thank you very much for the opportunity. I think that what we were trying to do with this article, which was part of a wider project on looking at the whole range of products which have been in the intermediate market, and this was particularly on the comparisons between countries. But the core issue is that in most European countries, social renting is declining, and that's true in many other countries as well, and that income inequalities are also growing, and COVID is going to make that worse. So governments are looking for intermediate tenures, which can be low subsidy or maybe even made to work just by improving the way the market works. So affordable home ownership is basically either something where government can make the system work and reallocate risk and do other things of that sort, or it's about subsidy of one form or another. Now, what we found across most of the countries who answered our questionnaire, and thank you to EMF for helping that, is that most governments, not unusually, have multiple objectives. And so while they may be saying that what they're trying to do is to ensure that owner occupation grows or that it's more stable at the bottom end of the market, etc., they often have quite other objectives at the same time that they're developing their policies. So a very normal one is that countries want to support developers and new build outcomes rather than necessarily just to help particular groups to get into the owner-occupied market. But the growing evidence is something which we didn't see until 20 years ago, which is income and household related subsidy systems, which help families or help other particular groups. And so it becomes more part of the welfare system than particularly the housing system. In terms of government-sponsored instruments, there's a range of products. Probably the oldest of these is the situation such as community land trusts, where you split the land from the dwelling. The people only buy the dwelling. The land remains either with a local authority or with a trust of some form or another. Very normal in the United States, very normal in a small number of European countries. We hardly do it at all in Britain. The second type of product, which is particularly Britain and the Netherlands, but also Australia and one or two other countries, are shared ownership products, where you buy half of the product and the housing association or the local authority has the other half, and you may be allowed to staircase up to 100% if the situation allowed. In inflationary worlds, it was very easy to staircase up to 100%. In the modern world, it's very, very much more difficult. And what has come out much more generally over the last few years is equity mortgages, where the government provides 20% or a percentage of equity mortgage. They take risk on that proportion. The person who gets this mortgage has lower outgoings and lower deposit requirements and is taking a lower level of risk. It looks like a pretty good product in the COVID world, as long as you don't mind governments taking risk. But the private market is very different. The private market for equity sharing or shared ownership is fundamentally for the more sophisticated user. And in countries where it's developed, Australia and America, it's mainly for people who really know how they want to allocate their risks, rather than it being an affordable housing product. Extremely difficult to operate because of the data required to make sure that you've actually got a real understanding of what's going on. But what we are beginning to see is a lot more layering, in the sense that for instance, when you're an affordable housing provider, you may you may get money at very low interest rates, and then above 70% higher interest rates, and the top 10% much higher interest rates, reflecting different risks. And that, I think, is where the institutional investors, the ones which we're worried about in the rental market, are beginning to come into the mortgage market. So moving on to the future, please. The next slide. Where are we going? Well, I think the whole issue of multiple objectives of governments and what the economic environment is are going to determine what types of products come forward. The sort of multiple objectives, we end up with overlaps and we end up with gaps in terms of what is being provided. But on the whole, the more sophisticated the mortgage market, the larger the mortgage market, the more is being produced. And in some contexts, that means that governments take the issue of guaranteeing the top end of the risk, particularly. But I think the most important point from our point of view in this, anybody's point of view, is what the hell the economic environment is going to look like in 5 or 10 years' time. We develop many of these products in times of inflation. If we're going to be in a low inflation, low growth world for the next 20 years, we have to rethink these products to make sure that that meets it. But we take the issue about, is this a Japan style of the last 30 years? But some of our economists and financiers are very, very worried about Japan in the next 30 years, because as working age population goes down, the capacity to develop, to increase incomes goes down. There is a very real concern that there will be very significant inflation. we have one or two very, very competent people predicting significant inflation in 5 years' time. So we shouldn't build everything on the basis that we're in a low inflation, low growth world. So the question in a sense is much more fundamental. Do we want people to be owner occupiers because it gives them stability? It means that they can organize their payments around their life cycle in a much more effective way. And governments don't end up having to pay for the last 30 years of their lives in rent subsidies, which is happening in many places. So I think the fundamental question is, do we want intermediate market products? And what type of economic environment have we got? And then some strategic thinking by government. Thank you very much.
Thank you, Christine. Just on that last point about well, rent subsidies you mentioned specifically there, and I guess also pensions. If we're in a very low low interest rate environment, pensions become less and less able to cover costs. And if you are in an owner-occupied 30-year mortgage kind of model, your biggest monthly outgoing is eliminated by the time you retire. So the need for pensions is much less than if you're in a buy-to-let kind of environment. Christine, can I ask one topic, ask you to elaborate on one sentence in your article that you didn't mention again here, which is the last sentence. We say in your article that lenders and investors are coming down the risk curve and retreating from innovation. Can you just elaborate on that a little bit and that comment's implications?
Yeah. Of course, it's a sentence written by my colleague rather than myself, but I think what we are seeing, what has been really interesting in the last few months is that after the financial crisis, almost any market innovation stopped. We had a situation where we looked at partial equity products and so on. In 2013, there were lots of things just coming forward. Then things changed again and everything stopped again. So it's a very market volatile world. But what we are seeing, I think, in these layered products, which are really beginning to grow again, or at least come to the market again, I'm not saying they're growing much, is that we have got very different levels of sophistication in the supply side of finance in this context, as well as on the consumers. And to some extent, that is enabling people to change the makeup of a risk which they are prepared to take. It's a much more complicated subject than that, but that's probably what I think of most.
Yeah, it's a very, very valid topic. I'm not sure. Should we, Daniele? Should we throw it open for general questions or specific? Should we go to the overall Q&A session now?
Yes. Now we can consider the specific panel section completed. We have now 10 minutes till 12, so we're perfect in time. I would like to open the floor to any specific question, general question to Hypostat, to the panels we heard. Thank you. First of all, so thank you very much for all the moderators and panelists who guided us through very interesting topics. Now I open the floor for these last 10 minutes for any question you may have on the publication in general or the event now in specific, or any panelists or moderators. The floor is open for questions.
Can I try to break the ice? And I have a question for Christine and for Luiz. I think it's very interesting to see how the housing market is linked to the mobility of the European citizens. And I think that this crisis can change radically the movement of young people in the continent. In the last 10-20 years, we have seen massive young people moving from the south towards north. The German Federal Statistic Office was not expecting to have 4 extra million of people in Germany buying houses in their major cities and bringing the housing price up. I'm asking myself, what will be the impact of COVID on this movement? Smart working will probably not oblige Portuguese engineers to move to Munich anymore, or to go to London or to Amsterdam. What is the relationship between movement, internal, let's call migration, but is I think allocation of resources, and the new COVID situation? We are thinking that we should build in Hypostat the idea that Europe is done by integration of markets, but also mobility of citizens, and the mortgage market will be deeply impacted. And my last point is also, if we have to think how the tourism industry will be impacted. Airbnb in Lisbon, Barcelona will actually change the dynamics. So it's not only moving for work, but also moving for tourism, which will be impacted by this crisis. And what are the implications for the housing market? Sorry for the length of the question.
Well,
perhaps I start? Sorry.
No, go ahead, Christine. Sorry.
We did that. I think that the most obvious immediate reality of COVID is that young people are even more living with their parents or with other relatives or people prepared to put up with them. It's gone up enormously in Britain. In America, I think it's now over half of people under 35, whether they're married, whether they're single, whatever they are living with parents. So that by definition stops them moving until they manage to find a good job somewhere else. And I think that's going to be a real issue in all of this. And the other general point in this context is that, you know, in many, well, certainly in Britain, but I think in many other countries as well, and certainly the work we did for the OECD showed this, is that because jobs are so much more insecure right across the system, people's capacity to get mortgages is very much less when they're younger. And that is reducing the young people's access to owner occupation right across the world. And that, I think, is partly why the affordable home ownership things are seem to be so important.
I have a question. May I proceed?
Please, Wolfgang, go ahead. Thank you.
In Austria, we see a development that single-family homes in rural and semi-urban areas are getting much more attractive and have quite substantial price increases. So there seems to be a movement, a migration flow from the cities to the outskirts and suburbia. Is this I think this is driven very much by the trend of home officing. So if you work only 3 days or so in the week in the office in the city, it becomes quite attractive to move to a further distance to the city. Is this an effect which is observed in other countries also? And is this something of growing significance in terms of housing finance?
Could I come in, Luca? I think the question that you mentioned is about mobility is crucial, and I think, well, Christine mentioned several aspects of it, but there is one that I think is particularly important in the current juncture, which is the recovery after COVID will be faster and stronger where there is more mobility of resources, right? Where capital will move faster from companies that will go bankrupt towards firms that are more have stronger growth potential, where workers that are currently operating in sectors that will likely shrink, the extent to which they can move to activities and jobs really in sectors that will grow faster. So there is a very strong link between the recovery and labor mobility, and we know that one of the key deterrents to labor mobility is residential mobility, in the sense that, you know, we see that countries where there is a high rate of owner occupancy are countries where typically there is less labor mobility from the point of view of people moving across regions, no, not from other aspects of labor mobility. So the extent to which choices over the tenure have an impact on residential mobility and in turn on labor mobility, I think we will see that there will be a lot of, let's say, stylized outcomes that we are going to see in the recovery that has to do or have to do in the end with those choices and those structures. And we see that there is a lot of difference or diversity across the European countries in the tenure structure. I mean, we have countries with a very high home owner occupancy, let's say Southern Europe, countries with very low home owner occupancy like Germany or Switzerland, and so those starting points will affect to some extent the degree of residential mobility and in turn labor mobility at a phase where it will be very important for the recovery. And that ties in with, I think, one of the questions that I wanted to raise, but time will not allow it, to both Christine's comments and what Max said about the housing finance, is that to what extent does the tenure structure of a country affect the development of those markets, the convergence? One of the reasons why you may not have convergence in mortgage markets is that the tenure structure is very different. So there will be less demand for mortgages in places where there is already very high owner occupancy, or in countries where there is a preference for rental accommodation and so on. So I think those are very interesting issues that bring us back to social preferences or a lot of legacy in past experiences of finance that basically explain why we are where we are in terms of tenure structure, and how that in turn will influence mobility, the speed of the recovery, the development of mortgage markets, and so on. I'm sorry I've been a bit long, but I thought that ties in very well your question, Luca, with what Max and Christine said.
May I respond very quickly on one particular point? I think we did work, 25 years ago, I guess, on the tenure structure in terms of typical people age 25, typical people age 40, typical people age 60 odd. And while we get these enormous variations, and I agree Eastern Europe is a bit different from this, we get these enormous variations, it's all in the young people. So by the time we get to 45, if you are a couple with a couple of children, your chances of being an owner-occupier were roughly the same in Germany as in Britain, which, given the massive difference apparently, was really, really important. So I think in terms of this kind of question of social values, what people want in their housing versus their capacity to move, fundamentally, the story goes, you may move house and move job an awful lot until you're 40, but you don't move much after that. So it's looking at this younger age group, which is what I think is most important.
Can I make a comment on what Wolfgang said? Because I think Wolfgang said something very important. The outskirts are becoming more and more interesting. I mean, in Brussels, starting from the 1st of January, there are a couple of measures which are quite interesting. First of all, you cannot drive more than 30 kilometers per hour. And the car taxes will change, that you will pay your car taxes in function of the kilometers that you do per year. I think this will have a massive impact on the labor market in Brussels and also on the housing system. They were calculating, for example, a nurse coming from the Flemish areas to come to work to Brussels has to spend 1,300 euros more per year with the new taxation system. So it will be disincentivized to be active on the labor market in Brussels. Of course, the purpose is to reduce traffic to Brussels, but I mean, this will change massively the appetite of, I would say, the middle class to work in Brussels and live outside. Either they will move in Brussels or they will simply stay where they are and look for a job over there. So I think what Wolfgang said, I think, is a trend in Europe. Most of the cities are thinking of something similar. So stay tuned because the market will change. Richard, I don't know if you wanted to raise a point. I think you wanted to.
I did. It's an observation on Max's first presentation on the energy efficient mortgages. I think that correlation which is demonstrated between probability of default and energy efficiency is obviously really important to the whole upgrade and whole greenification of mortgages. But it's only a quantitative thing, and I think we could spend a huge amount of time speculating about the reason for the causation. But one thing I'd really like to know, and I don't know if anybody has any numbers on this, is whether there's a correlation between wealth levels, between which percentile you are and your energy efficiency. And I'm wondering if part of the reason for the correlation that Max identified was that wealthier people tend to have more energy efficient houses, and as heating costs increase, this becomes more of a divisive thing, putting more people in fuel poverty. And I think it would be really helpful to understand if there is a correlation there. My gut reaction is probably yes, that probably poorer people in lower incomes will have less efficient energy efficient houses, but I have no idea if there's any empirical evidence for that.
Well, this will be also, I will say, accelerating with the current taxonomy, which is making house category A very eligible for taxonomy, the rest not. So I mean, it's a Tesla approach. It's not the Fiat Punto approach. I mean, so I mean, this is just the correlation will be exasperated by regulation in this case.
Richard, we made analysis on the basis of EU Silk, comparing the lowest income quintile and the median of households in terms of fossil or regenerative energy sources for heating. And the outcome was that in the field of single family homes, low income households indeed do have higher share of disposable income to be spent on heating, but not in multi-apartment housing. This seems to be the reason that social and affordable housing in many cases have more efficient heating systems. But this is a database available for all Europe. This could be an interesting source for comparative studies.
Mm.
With this, I think we thank you so much for all this intervention, and I see also from the discussion that we could go on for another couple of hours on all these very interesting points and thoughts of future analysis, correlations, and papers. You all have given us a lot of food for thought for sure next year's Hypostat, where for sure we will have a lot of other further external articles. And let me take advantage of this moment here all together also to invite you to come back also to us if you would be interested in providing us any your support in drafting something for next year. 2020 is about to end. Next year is about to start. We are also starting already the preparation and the draft, the programmation of next year's Hypostat. So it's a good time to raise your hand if you are willing or have some time to help us on some of these on very interesting points. Unfortunately, our time today has finished. Thank you so very much to all the ones who participated and to were responsible for this very lively debate. I hope to see you all physically for our next Hypostat event, which will be scheduled for next year, shortly after the publication. I think this has been a very nice first time to show the wealth and the informative material we have in this nice publication. Looking forward to see you all soon. Stay safe and all the best. Thank you so much. Goodbye.
Thank you, everybody. Bye-bye.
Thank you. Bye.
Thank you, everyone.
Bye-bye.